Okay, what's up everyone? This is Scott here again with a brand new video to help you learn how to trade, invest, and master your finances so you can apply that knowledge in the real world and multiply your money. And as always, today is Friday, so that means what I have here is my next episode of my live option trading series, where I show you all the trades and all the adjustments I made this past week. And so as I said in last week's video, this week I was hoping for a continuation in the selling pressure across the market. So for example, if we come to the charts real quick here, I have pulled up SPY. This is an ETF that tracks the S&P 500. And as luck would have it, that's exactly what's been happening this week as well. A lot more selling, especially on Wednesday here. Now, of course, in the grand scheme of things, having the market come down from a high of around 473 to a low, at least so far, of around 450, from high to low, that's only a drop of about 5%. So really not a huge deal. We've seen this kind of thing many times before. But at least especially on this day, on Wednesday again, right, you could probably consider this a very small mini crash. And of course, most of the selling and most of the fear here was caused by the new Omicron COVID variant. And so the main focus of this video here is going to be showing you how I managed all my positions during a major market sell-off. Because in particular, if we come back to the monitor tab real quick and I show you my positions, everything I have on right now is either a short naked put option or a short strangle, which of course also contains short put options. And so with the one exception of my Crocs position, every single other one of my positions, all these stocks took a nosedive this week and blew through all my short put strikes. And unless I managed these trades the way I did this week, I would have massive losses on my hands. Especially today as well with the market selling back off once more. But if we come over here and take a look at my P&L for the day so far, things are looking really good right now. And so then also in this video, alongside all of that, you're going to see how I put on my new position in Crocs. This was my most recent trade here. So in real time, you're going to see my entire thought process and my full reasoning behind putting on that position. And then you're also going to see how I took my profits in my Roku trade this morning. This was also a simple naked put option here, where the stock took a massive nosedive and blew through my put strike, but through my management tactics, I was able to totally turn this trade around into a very nice winner. Now, as always, before we fully dive in here, in case you are brand new to the channel, I just want to let you know that you can also find me on Skillshare as well, where you can take my very in-depth classes on options trading or stock market investing. And I provided some links to some of the introductory courses of mine in the description of this video below. So be sure to check them out. And when you sign up for Skillshare using any of those links, you'll get a full 1-month free trial. Okay, and so with that being said, I'm going to stop here and play a few clips that I recorded from this past week that, like I said, will show you in real time the new trade I put on in Crocs, and then also the various adjustments I made on all my other positions. So let's get started. Okay, today is Tuesday, November 30th, and the stock I'm going to be trading here today is Crocs once again. So of course, this is the company that makes those lovely looking sandals, and if you come down here to the implied volatility chart, let me expand this up a little bit here. There we go. So we are continuing to see a nice buildup of the implied volatility for this stock here. Basically a buildup of uncertainty around this company's future. And so for those of you who are new to the channel, or for those of you who are new to options trading, when this happens, this also increases the prices of the options on Crocs. So therefore, someone like myself, who is an options seller specifically, I intentionally look for increasing amounts of implied volatility, right? Because it should make sense that I want to find the highest priced options, because if I'm correct on those trades, then that makes for the biggest profits. So right now, based on the current level of implied volatility for Crocs at 54.3%, this corresponds to an IV rank of 33%, that's decent, and also an IV percentile of 53%, also not too bad. And again, in case you don't know, these two metrics simply tell you how relatively high or low the current level of implied volatility is for Crocs compared to the past, right? Because as you can see, over the past 1 year, the implied volatility for Crocs has gone up quite a bit and come down quite a bit. But that being said, every stock still has a rough average of where the implied volatility for that stock likes to hang around, right? Some stocks are more volatile than others. Some stocks have more uncertainty around them, like Tesla, for example, while other companies, let's say Coca-Cola, which are much more stable, stocks like that on average are typically going to have much lower implied volatilities. So again, point being, the IV rank and IV percentile indicators will tell you for this particular stock, is the current level of implied volatility high or is it low? Or is it pretty much right around the average? And so in particular, what I look for is stocks with generally higher implied volatility on average. 54% is pretty good. but also I want to find stocks where the implied volatility is above average for that particular stock. And the reason for that is twofold. Number one, of course, the higher the implied volatility, the more expensive the options will be. That's a good thing. And then also, if you look at this chart, and also keeping in mind, like I said, that implied volatility likes to typically hang around an average for this particular company. So that means when implied volatility gets too high, it will always come back down. You can see it again here. Implied volatility spiked and boom, came back down. Then once more right here, came back down. And one more time right here, came back down. And of course, like I pointed out earlier, we're seeing the next big buildup of implied volatility. Now, of course, there is no way to know if this right here is going to be the top of the next peak, or if implied volatility will continue to move up higher. Of course, you can't predict the future, but still, being patient and waiting for moments like this where implied volatility does spike, that's typically going to put the odds in your favor of a contraction. So therefore, the whole idea is sell options around this point or around this point when their prices are very high. And then hopefully sooner rather than later, implied volatility will contract and come back down and therefore bring the prices of the options back down along with it. And that allows you to buy those contracts back for a cheaper price and make the difference as your profit. So with that said, now if you come back up to the price action chart, the last time I did trade this company or this stock, I did note this resistance trend line, which you can see here in red. And hopefully it's pretty obvious here that every time this stock got up to this resistance point, it came right back down. And so in particular, my last trade on this company was right around this point. I sold a naked call option. That's a bearish position. And I made that trade because, again, I noted this point right here where Crocs hit this trend line and then began to move back away from it. And then as you can see here, it did fight me for a few days, but ultimately the stock did break back down and move lower. Now at this point, at this price of about 163 bucks per share, I'm not really bearish on the stock, not super bullish either. And so as a result here, I think I'm going to put on a slightly bullish skewed strangle. Basically, I'm going to sell an out of the money put option and also an out of the money call option. But I'm going to pick my strikes in such a way that, again, the entire position is going to have a slightly bullish skew to it. So therefore, we'll come to the trade tab now and take a look at the option chain on Crocs. As you can see here, I'm still in the December expiration cycle with 17 days left to go. I want this to be a pretty quick trade, and also, as you can see with the prices of these options, they're still all very, very expensive. And so I think what I'm going to do here is sell the 155 strike put option, and then alongside that, the 185 strike call option. And so because the delta on this call option is only 14, and the delta on the put option is 30, that's what gives this position a bullish bias, the fact that the delta on the put option is larger. And so that means if Crocs were to start moving up in price, then the entire value of this whole position here would drop by some number. And that's what I want, right? As an option seller, I want to sell options when their prices are high and then buy back the contracts, buy back the whole position for a lower price. So with that said, we'll go ahead and set up the position here and see what the premium is like. So go to sell and then strangle. Okay, and here is the order. I'm going to sell one contract of the 185 strike call option. And then also at the same time, I'm going to sell one contract of the 155 strike put option. And over here, as you can see, the total premium or the total credit I'm going to collect for selling these options is about 515-ish bucks, which is very good considering there's only about 2 weeks left until expiration. So perhaps I'll try and lock in a price of maybe 515, see if I can get filled around that point. Go to confirm and send. Buying power effect is about 2,500 bucks. That's fine. So we'll go to send. Okay, and no fills yet on this order here, so we'll come back to the monitor tab and perhaps change my price. Right there is my order. And as you can see, my limit price is still 515 and the mark price is also exactly 515, but perhaps I will have to come down maybe a few more pennies here. So let's come down to maybe 510 and see what happens now. Confirm and send, send. And there we go, just got filled at 505. I did have to come down a bit more in price there. Very nice. And then, of course, the last step here is to set up my automatic buying order to book my profits if I am indeed correct on this position. So let me go ahead and do that real quick. And here we go. This is the order. Just going to buy back both contracts of the 185 strike call option and the 155 strike put option. And I'll do so for half price. So half of 505 is about 250 or so, just rounding down a little bit. So again, perhaps if we can see a small little bounce in Crocs, also if implied volatility can contract a bit more, and then also don't forget about time decay. That always eats away at the value of any option as time marches forward. So hopefully All three of those things can together reduce the value of both of these options that I sold this morning to a point where their combined value is only $250. At that point, this order will get triggered. I'll buy back both contracts and I'll book some nice profits. So last step is to make this a GTC order so it's always in place, and then confirm and send, all done here. Okay, today is Thursday, December 2nd, and in this clip here, I'm going to go ahead and make an adjustment on my NUE short strangle. So for this trade, if I zoom in a little bit here so it's easier to see, I am short the 107 strike put option right around there, and that's where the main issue lies with this trade currently. And then also, I'm short the 125 strike call option right there. Now, with the entire market taking another nosedive this week, NUE, as you can see here, was not excluded from all that chaos, so it did cut through my put strike a couple times this week. And so the way I personally manage a short put option that gets breached is once the stock does cross my strike price, I will short the full amount of shares to cover the put option. So basically, once NUE falls below 107, at that point, I will short 100 shares of the stock. And then should NUE bounce back above my 107 put strike, I'll buy the shares back for a small loss and continue forward. Now, unfortunately, what can happen sometimes, as what's been happening with this trade, is the stock can continually bounce through your put strike or any strike over and over and over again. And as I said, every time that happens, I do lose a small amount of money, typically around 20 to 30 bucks or so. And so for NUE, this stock definitely has bounced through my put strike many, many times. And then also yesterday morning, once the market opened, this stock did also have a very large gap move over my strike, and I lost a lot more money than I typically would like. So point being, if we come back to the monitor tab now, these are the orders that got triggered this morning. So as of the market close yesterday, I was short 100 shares of this stock. And then this morning, NUE did bounce back above 107. So this is the order to buy back those 100 shares. And as you can see over here, the price I got filled at was 107.01. But then for a few minutes, as I was explaining, NUE was continually bouncing through that 107 put strike multiple times. And as you will notice, every time that happens, I'll short the shares around 106.80, about 20 cents below my put strike. And then if it bounces back above and crosses 107 again, I'll buy those shares back. So in this case here, I lost about 22 bucks. And then for the next time it happened, I lost about 24 bucks and so on and so forth. So point being, these losses have begun to add up pretty significantly for me. And so now I do need to make an adjustment. Specifically, I'm going to roll in my call option and take in extra credit to compensate for these losses here. And normally I would not even make an adjustment to take in extra credit until I lose a bit more than half of my total credit, my total starting credit on the whole position. And that's definitely the case for me right now with NUE. So if we come to the trade tab now, and again, as I explained earlier, I'm short the 125 strike call option, which is super far out of the money now. So what I'm going to do here is buy this contract back and then sell a new call option much closer to the stock price. And as you'll see when I do that, I'll take in additional credit. And right now I'm considering either rolling down to the 115 strike call option or perhaps the 114 strike call option. Just depends on how much credit I can collect here. So let's start off with the 115 strike call. I'm going to right click on that one here and go to sell and then vertical. And that's because the way I like to make these adjustments is basically selling a vertical spread where, as you can see down here with the order, I'm going to sell one contract of perhaps the 115 strike call option and then also buy back the 125 strike call option that I sold initially right there. So essentially by placing an order to sell a call credit spread, that's actually how I'm going to make my adjustment here. And so for this adjustment, I can take in an additional 140 bucks of premium. But also let's see what I can collect if I come down a bit more to perhaps the 114 strike call option. Now it's 167, almost 170. And I think that's what I'm going to do here for this one. I'm going to go with the 114 strike call option. So perhaps I'll lock in a price of maybe 165. I'll try and get filled here very quickly. Go to confirm and send. And no fills yet on this order, so we'll come back to the monitor tab and perhaps adjust my price a little bit. And never mind, just got filled at 170 actually. Awesome. So there we go. Did not need to change my price after all. And now, as you can see down here with the order getting filled and my price being 170, I have now recuperated all the losses I took this morning with the stock. And also now my entire net credit remaining on the position is back above my initial profit target. So specifically, I'm trying to make around 250 bucks or so on this one trade. And my total net credit on the position is now back around to, I think, 280 or 290. So that does also mean in order to keep that full premium, I will have to be in this trade pretty much all the way to the December expiration date, which is only about 2 weeks away at this point. And then also I do want to mention in regards to my AMD trade, which you can see down here, this one is also a short strangle, and I did have to make an adjustment to this one as well yesterday. So initially for this trade, I was short the 160 strike call option, as I still am, and then also I was short the 130 strike put option. But now as you can see here, I'm now short the 147 strike put option. So in a very similar fashion to what I just did with NUE, I did the same thing with my AMD trade here. I rolled up my put option in this case, and once again in doing so, that brought my total net credit on the whole position back up to where I want it to be for my profit target. And then finally in this video, I do want to touch on briefly, as I mentioned, the fact that the market has been selling off like crazy this past week. So if we come to the charts real quick and we go to SPY, this is an ETF that tracks the S&P 500. Now today, as you can see here, the market is recovering a bit, at least so far, but yesterday in particular, this was a massive, massive down day. And pretty much all stocks across the board got killed, which also meant for all my positions that do involve short put options, which is pretty much all of them, with the exception of Crocs, all the stocks did fall below my short put strikes. So for example, if you go to my Alibaba short put option here, as you can see, I'm short the 130 strike put option. And then also right above it, I'm short 100 shares of the actual stock, which right now, if you look at this column, the current price for Alibaba is $124.45, over a full $5 below my short put strike at 130, right? So then if we come all the way to the far right into the P&L open column, on the short put option, I've lost a total of $350. But also on the short stock, I've made back $520. So therefore, the net effect on this trade is I'm actually still up by about $170. Same thing with my Beyond Meat trade. For this one, I'm short 2 contracts of the 72 strike put options. And then also because, again, the stock is below the put strike right now, I'm short 200 shares of the stock. 100 shares for each contract, basically. So once more, if we come over to the far right to the P&L open column, on the put options, I'm down by about $700. But on the short shares, I've made back over $800, around $870. So therefore, the net effect is overall in this trade, I'm up by about $160. And same thing with my Roku trade, same thing with my AMD trade when I was long 100 shares of the stock for a couple of days as it was above my call strike, and same thing with my CPE short strangle, and so on and so forth. So point being is when you are selling naked options in particular, when you have undefined risk when you put on the trade, you have to have a good way of managing or defending that trade when things go wrong, right? For example, also with my Roku trade here, as you can see, I'm short the 222.5 strike put option, kind of a weird strike. And just from yesterday's sell-off, this stock fell from a price of around 228 or 230 all the way now down to a price of only 207. And if I did nothing to defend this trade, I would be down by over $1,000. And of course, if this stock just keeps on going lower, these losses are just going to keep getting bigger and bigger and bigger. But again, as you can see with a short stock position, I've made back about $1,400. So I'm actually net positive on the trade so far. So bottom line here, guys, is always make sure you have some solid trading defense. You don't have to trade the way I do. This is simply my style of options trading, but you still need to have your defense mechanics in place. You must know what to do when trades go against you. And in my opinion, your defense is actually more important than your offense. Because in cases like this, where the stock just moves extremely far against you extremely quickly, it can only take one really, really bad trade to wipe out all of your profits. And so that's why my entire general approach to trading has always been to focus on making small, consistent wins with very manageable losses. So definitely keep that in mind. Okay, welcome back. I hope you enjoyed those few clips there. And so now let's go over my Roku trade, which I took off this morning. So like I said earlier, this was also a simple naked put option, right? And if we go to the charts real quick here, go to ROKU, and I'll zoom in a bit. Take a look at what's been happening with this stock this past week too, right? It's been coming down pretty hard almost every single day. And at the moment, it's a full $22 below my put strike, which means if I did nothing to manage this position, I would be down by probably, I would say, between $1,500 to $2,000. But as I've explained throughout this video, the way I manage a short put option that does get breached is I will short the full amount of shares when that happens. And so it was on this day right here, I believe Wednesday, when the biggest sell-off occurred, where Roku cut right through my put strike, and at that moment, I shorted the full 100 shares. And so if we come back to the monitor tab, we can now figure out the final P&L of the whole trade. So briefly, I'll pull up the calculator and I'll move this down below. So initially, I sold this put option a few days ago, I believe last week, for a total credit of $900. And I believe at the time, Roku was around, I would say, 230 bucks or so. Now this morning, as you can see, I bought back this contract to close for a total debit of $2,065. So therefore, we subtract $2,065, and therefore on the put option, I've lost $1,165. So not quite as bad as I thought it would be, but still, if I did nothing, I would have lost almost $1,200. Now I'm going to go ahead here and clear the screen, but don't forget this number, 1165. And so once Roku fell below my put strike, I shorted the shares as I explained, and the price I got filled at was $221.95. And so if my put strike was at 222.5, that means I got filled 55 cents below the put strike, right? So ideally, I would have liked to get filled a bit higher in price, a bit closer to 222.5, but this price here was definitely good enough. And so then also this morning, as you can see here with this order, I bought back the 100 shares to close, and the price I got filled at this morning was $204.85. So I subtract from here 204.85, and that means I made a profit of $17.10 per share, multiplied by the 100 shares, right? And that gives a total profit of $1,710. And then finally, the last step here is to subtract the $1165 that I lost on the put option, right? And the net effect is I still make a profit of $545. And so there you go. This is how I turned an almost $1,200 loss into a $500 winner. And as I showed you earlier in this video, this is how I've been managing all my positions, all the ones where the short put options got breached. And that's why if you come over here to the P&L open column for all my trades, things are looking pretty darn good. And then especially if you look at the P&L year to date, at least for the stocks I have trades on right now, as you can see, I have made money on every single one of them. Not trying to brag by any means, but just trying to offer you proof or evidence that what I'm doing here actually works. And so then also, as you can see this morning, I do have a few orders that got triggered in AMD. These were my automatic hedging orders to short the stock should it fall below, of course, my put strike. So as I showed you earlier in this video, my put strike right now for AMD is at 147. And right now the mark price for AMD stock is all the way down to only 142. Almost a full $5 below my put strike at the moment. And so far my stock hedge here is working really nicely. I've lost about $700 on just the put option, but I've made back over $400 on just the short shares. And then of course also because AMD is moving lower, that's why I'm making money on the call option too. And so with that being said, that's going to do it for this video. I hope you enjoyed it, and please let me know your thoughts or if you have questions in the comment section below. And don't forget, if you want to take some very in-depth classes on options trading or stock market investing, then check out my Skillshare courses. Links in the description of this video. And finally, if you enjoyed this video, then please give it a thumbs up, drop a comment, and subscribe to my YouTube channel. I drop new videos every single week, and you don't want to miss out. So thanks again for watching, and I'll see you next time.